This event is presented to you by InvestHorizon in collaboration with EBN, the European Business and Innovations Network. InvestHorizon is an EU project supported by the European Commission and Eureka. We're here today with Frédéric Domas. He's the CEO of Upstream, an innovation consultancy based in Toulouse, also member of EBN. The goal of this webinar is to introduce cash flow management for early stage companies. It will be available for replay on our website, InvestHorizon.eu, where you can also find all our past webinars and online classes. Register to our community and be informed of upcoming opportunities. If you are an entrepreneur in a deep tech sector, currently seeking a Series A investment, have a look at the Accelerator program. It's a great opportunity to get high-level support in your investment search and direct contacts to European VCs. This is an ongoing application platform, so you can now start your application and be selected in our next round at the end of July. Understanding how to handle your cash flow at the start and accelerate growth with very little money is often a challenge for early stage entrepreneurs. Our webinar today introduces what are cash flows, how to track them, and strategies to anticipate the financial needs of the business over time. Frédéric Domas, our speaker today, has 30 minutes to share some insights and provide practical tips. He's the CEO of Upstream, consultancy company supporting innovation. Frédéric co-founded several innovative companies and created a computing center for biotechnology startups. He's the former innovation director of the Haute-Garonne Departmental Council and managing director of the Business Innovation Center Théogone. Frédéric supported 300 companies with a 95% success rate. So after his presentation, you will have 30 minutes to ask all your questions. You may already start submitting your questions during the presentation in the questions window. Please make sure to be clear and concise when typing in your questions so we have enough time to go through all the questions. So as usual, before we start, we're going to do a super quick roundtable to know who is in our audience today. So I'm going to ask you to select who are you, an entrepreneur scaling up, not yet scaling up, an innovation expert, or a financier. Give you a few seconds to answer. Okay, we have, as usual, 30% are scaling up, 35% are not yet scaling up, and we have 35% of innovation experts. Second question. If you ever had cash flow problems, was it because of a lack of turnover, your clients were not paying, you had long delays in payment from clients, or ongoing investments? Or you never had cash flow problems so far? Just a few seconds to give you time to answer. Okay, so 50% answer a lack of turnover, 38 long delays in payment from clients, 38 ongoing investments, 12% clients were not paying, and 12% never had cash flow problems so far. So thank you all. Frédéric, you may now start. You know who is there, and you have 30 minutes. We'll go through the questions afterwards.
Okay, thank you. Thank you, Perrine, for this introduction. Hi, everyone. Today we will talk about cash flow, and I hope that at the end of this talk you won't be afraid anymore about cash flows. before starting, I will to share some preliminary facts with you that could be really interesting. I recently finished a work with the London School of Economics and Political Science, and we collect some very interesting facts about cash flows and small businesses. So in 2018, in the UK, there were 5.7 million of SMEs that represent 99% of the economic tissue of this nation. 78% of these companies say that they had trouble about being paid by their customer and have to wait at least 1 month beyond their agreement term to be paid. And when we look at this this category, 40% of these companies say that they had some special issue with large businesses, and large businesses were the worst late paying offender. At the conclusion in 2018 in the UK, 1 over 7 companies are so big trouble with cash flow that they were not able to pay employees at the end of the month. That means that approximately 900,000 companies were not able to face to their payroll duty. And if you take into account that small businesses are in Europe approximately about 10 employees, you have 9 million of people that were not paid at the end of the month. I hope that just this piece of data will show you the importance of cash flow and the importance of managing in a better way your cash flow. So as I try to do a good presentation, I will begin by some definition of what are cash flows. Well, cash flow is an indicator, and you must look and track the cash flow evolution of your company. And as you can see on this slide, it just have 2 ways to evolve. The first one is a positive one that leads to a wealth situation, and the second one is a negative evolution. And then, as you can see, it could be very problematic. So cash flow is the oxygen of your company. And if you have something to learn from this this presentation is that SMEs live and die by cash flow. So what are cash flow made of? Well, cash flow can be divided in 3 main components. On the left part of the slide, you can have 2 very tricky components. The first one is the investing activities. I mean, the cash used to buy or sell some equipment, for example. And you have also the financing activity. That means the cash you have to when you do some loans to the bank, or maybe when you raise some funds to investors. These 2 kinds evolve, but maybe few times in a year. The third component, which is operating activities, is the cash that you made or spent to produce your good or service. Then it will change every day, every month of the life of your company. So in the next slides, we will just look at the operating activities component. And if you understand for this component, it will be very, very easy to translate to the 2 others. So I beg your pardon, but we have to talk about some equation now and to know how to calculate cash flow. So I try to give you a very short version, which is operating cash flow as a sum of net income and non-cash expenses minus the increase of working capital. But you can see with your accountant, there is a more precise formula that could vary a little bit depending on the country and the accounting system that you have, which take into account your net income, the depreciation, the stock-based compensation, the deferred tax, all the non-cash items, increase minus increase of account receivable, increase of inventory, increase of account payable, of accrued expenses, and increase in deferred revenue. And the whole sum will give you operating cash flow. It can be found, and you can see on the right of this slide that it can be found on your annual return, and you have a consolidated statement of cash flow. In this example, I took Amazon's one. As you can see here in orange, you have operating activities, but you have also here investing activities and financing activities. And as it is annual return, it is just compare from a year to another one to another one. This will introduce us the capability to monitoring cash flow. So we'll describe here a very, very simple tool that I encourage you to have. And there's no need to have an MBA, or maybe a common sense MBA, just will be sufficient, is to have just a table, which is the cash flow statement, as it is shown on the right side of the slide. And this table must be kept up to date. It's really, really important to track and to keep it up to date, and to enter cash flows, inflows, and outflows according to the months in which they are received. That means that, for example, you won't take in account all the accruals. Another very important point is that the amounts must be entered, including VAT, because it is the actual amounts which are disbursed or cashed during these months. And the third point, which is really, really important to check, is that the balance of the months and the balance on current account must correspond exactly to the bank movement. It is also a way to do some reconciliation between your bank account and all the transactions that you have. And it is a good way to manage your cash. So it may look like this. Then on this slide, you have the table here. And as you can see, there are some months that are in light gray and some months that are in blue. The light gray months are the completed parts, I mean the actual numbers, and the blue one are the forecast parts. And it's really important for you to have both parts completed with a lot of rigor. For the completed parts, for the reason I explained just before, and for the forecast part, it is because it will help you to know when you will need money and when you will need, for example, to use some venture capital to have new funds. And it's also a document that you can share. And why not share it with your banker? For the very simple reason that it's a proof of good money management. And you know, it's always better to talk with a banker when you are in a wealthy situation and to explain him or her how you are a good manager, and as you forecast your future expenses, you may explain and you may talk with him that maybe in 3 months, 2 months, 6 months, you will need some money, some loans, for example, and he will have time to study with you a solution that could be done for you, just for you. And it is better to do in this way rather than waiting the last before bankruptcy to go to the banker and ask him for a loan. Now I will just share with you some cash flow use cases. There is 2 main evolution of the cash flow, as I explained in introduction: a positive way and a negative way. So remember that positive cash flow is the situation in which you have to be. A healthy cash flow gives you some power, for example, to negotiate better payment terms, or maybe help you, as I explained, with your banker to being better approved for funding. But it is not because a company has a positive cash flow that it will be a good company for a long time. I took just this example. You may have a company that do not have changed its equipment for a while. Then the company has a lot of cash flow because the equipment are producing and are amortized and then cost nothing more. But if you try to continue in this way, you may have a problem that equipment become very old, and you may have a wreckage very important that maybe will impeach you to finish your manufacturing process and then to send your goods to your customer. So it is the way that you must choose positive cash flow, but it won't have to be a way to be neglected with the equipment and the structure of the company. The case of negative cash flow can be due to a lot of reasons. I describe here 3 cases. The first one is a little bit evident, but it's insufficient income compared to the expense. It is exactly the case when you are just starting up a business. You have a lot of expenses because you are setting up your products or your services, and there is no customers for the moment. At case number 2, you may have the case that I just explained, that the company has to buy new equipment, then the cash flow may be temporarily negative. And I insist on this. The fact that the cash flow could be negative is dangerous when it is chronic. If it is just temporarily, it may be solved by some financial tool. Case number 3, it's a case that some of you described and that I introduced in my talk, is when customers' payment take too long time and that the company must pay shortly as supplier. It may also be the case for young companies. Because you are young, your supplier do not know you very well, then there is a lack of confidence, and it can ask you to pay the whole cost of raw materials, or maybe a sufficient amount to have some confidence with you. Then, what are the cash flow strategy in those cases? Considering the case 1, insufficient income to compare to expenses, in this case, you may reduce expenses. It could be evident for you. It's when you have 10 euros in your pocket, you cannot give 20 euros. You have to maybe to do some reduce in expenses. You may also negotiate with your supplier to obtain some delay, but you must be cautious if the situation of a negative cash flow is chronically negative. And you may also, which is more evident but easy to say, is to increase number of customers to have a better income and then to have positive cash flow. What you have to take in account is it is really important to forecast this situation several months before it arrives. And it will help you to decide to use some financing tool, like loans with your bank, as I explained, or maybe if you have a young company with a very good situation in the future, you may ask a business angel or venture capital to invest in your company. And as you know, it takes some time, it takes many months, and then you have to forecast to avoid a situation of emergency. In the case number 2, case of new investment, then it is a little bit more simple. You can have a loan from the bank. You may negotiate with the equipment manufacturer, maybe to pay in 2 times, 3 times, and maybe have some delay for the payment. You may also negotiate with the supplier of raw material, because you have a new machine and new equipment, but you have to feed it with some raw material to create your goods, and it could be fine to obtain some delay from them. In the case where payment from customers are too long, it is maybe one of the most difficult. In this case, yes, you must negotiate with your supplier to obtain payment deadline, because you have also payment deadline delay, for your customers. You may also have a very clever strategy that is to encourage customer to pay earlier and to pay maybe the whole cost of the goods at the moment or when they order. It could be fine, for example, to give 10% to your customers if he can pay just when he orders. So you have to look and make your calculation of how much you can give to the customer. That is a good strategy. Another one is to use factoring operation or negotiate with your bank, and it is existing in some country, for example in France, with the DAI law, which is a method of financing that involves to transfer ownership of the portion of the customer position to the bank in exchange of a short-term line of credit that you have to pay, maybe 5–6%, but in exchange you will have cash right now. And as you know, cash right now is better than cash tomorrow. We cannot talk about cash flow without talking about free cash flow. So as you can see here, free cash flow is very simple and important, for example, for investors. It is the cash flow that results of the operation cash flow minus capital expenditures, and then it represents the amount of cash that you have effectively at your disposal. And it may be used in the case of investors to pay dividends, for example, at the end of the year. Let's look now at some tools that can be used with your cash flow. And I will make a focus on discounted cash flow. Discounted cash flow is a way to make investment analysis, because you calculate the value of an investment based on the present value and its future income. It applies to decide whether or not you have to buy new equipment, but also in case of company evaluation, for example, and I think that a lot of you that deals with the business angel or VCs will have already heard about DCF in this case. I will show you a very short example that could be used every day in your company. In this case, a company wants to buy a new equipment. The cost of the equipment is about 1 million euros, and the lifetime of this equipment is 5 years. So it will be amortized on 5 years. And then we will take a discount rate, which correspond in this case to weighted average cost of capital, about 10%. Then, as you can see there, if I invest 1 million today, I will try to guess what amount of money I will have in exchange of this investment. So I have do some assumption of future cash flow for each year, and then we just do the sum of this cash flow. And as you can see there, the total amount of cash flow, future cash flow, is less than 900,000 euros. Regarding to the investment that we have made, 1 million euros, you can easily calculate that we missed some money. And then we have approximately 100,000 euros that are missing. Then if you use this tool in your cash flow management and decision for invest or not, in this case, you will conclude that you do not have to invest in this equipment, maybe find another equipment, or maybe find another strategy to do what you have to do. So my example is very simple, but it is done to help you to better understand the importance of having tool to forecast your decision. I will just finish my talk about this brilliant citation of Buzz Lightyear. What's beyond? Well, I just presented some very basic tools that may do 80% of the work. Now, if you want to go beyond, you can use data science for business to analyze and predict cash flow. Why? Because a better decision can be done, for example, with better representation. You may have the use of these tools to have a better assumption, because as I explained, you have to forecast, and all the calculation that can be done by Excel, for example, could be good, but could be false if you have a worse or false assumption. You know, people say garbage in, garbage out. If you have bad assumption, you will have bad result and bad decision. So data analysis can help you to discover some hidden factor, for example, a seasonality effect or a special event. And I just show you this funny case, which is observed in Florida during Hurricane alert, that people are more likely to buy beer and pie than flashlight. And I promise it's real. It can be used also for you to create a statistical model, a complete statistical model, for example, using Monte Carlo simulation method. That could be better for forecasting rather than using the approximating percentage of change of payment that everybody learned in everybody's school of management. And then we arrive to machine learning on the basis of transactional data that could be useful because you have historical data on your business. So which tools for this? There's two kinds of tools, open source tools and non-free tools. Regarding open source tools, you have very good tools for statistics that are R and RStudio. If you are a developer, you can do this in Python. There is a lot of library about finance. Or you can use some CRM, for example, that includes some analytics for the business. And you can have a spreadsheet like OpenOffice. Concerning the non-free solution, one of my favorite is Tableau. Tableau desktop. I think they have changed a little bit now, but Tableau is a way to help you, even if you are not really a good statistician, to analyze your data and to find, for example, hidden factors. And you have also tools like a crystal ball from Oracle, which will help you to predict your income, for example, or Excel, that will be maybe the most common and the most easy way to do your cash flow statement and cash flow forecasting. Well, thank you for your attention. I think that we have covered a lot of cash flow, and I hope that now you are more comfortable with this problematic, this topic.
Thank you, Frédéric. It was very clear. So to the audience, if you have questions, it's the moment to type them in. As I said before, just try just to be short and clear in the question. Frédéric, how many businesses fail due to cash flow problems?
Well, this is figures that, depending on the countries, there is a lot of variation. But as I mentioned at the introduction, small business represent in the EU and in the US more than 80% of the economic tissue. And what we can see that approximately 80% of those business that fail due to cash flow problem.
Okay. Okay, I'm going to go through the questions. Is it true that cash flow is derived from the income statement and the balance sheet? Or is it old school and you can enter data into the cash flow first, which is transferred to income statement and balance sheet later?
Well, the cash flow derived from income statement. So you must have your income, because as I show in the equation, it is the first element of the equation. So you have to have your income and then deduce all the things that are you have to pay, and then what stay is your cash flow.
Could you explain again the free capital cash flow?
Well, maybe I can show you again the slide, if it is possible. To yeah, concerning the free cash flow, then you will have to deduce some capital expenditure. That could be, for example, when you buy some vehicles, when you buy some land, when you buy some computers, software, license, for example, then you have to pay this. It is not really in the operation, so but it could be useful for the company. Then it's just a term that you add to obtain the real free cash flow that you have, the real amount of money that stay in your pocket at the end of all these expenses.
Is there what are the main differences between B2B and B2C businesses?
Oh, well, concerning cash flow, I think that for B2C consideration, you may more easily ask your customer to pay when he orders. That means that you will have the cash before sending the goods or giving the service. When you do business to business, this is different, because, for example, if you work for a big company, if you act as a subcontractor for a big company, then you may have some problem, because you have to do the job and then the company will pay you after. And for example, some years ago, a very important helicopter manufacturer in France was divorced big company to pay small companies. They have more than 3 months of delay to pay young companies. So the company had to take in account from the order, the time to realize the service, plus 3 months to be paid. So it could be 5 or 6 months, which is incredible. And then it is really difficult to use, for example, factoring operator against a big one, because once you do it one time, the big one can say, no, next time I won't order in your company, I will change to another company. So yes, sometimes it could be more difficult in B2B consideration, but on the other hand, it is more easier to obtain a new customer in B2B because the amount of customer is very often smaller than in B2C, because when you have to talk to each people, it's very long and costly to find each customer. So it's kind of balance also.
Do you have any recommendation for a template to manage cash flow?
Oh, well, there is a lot of template that you can find on the internet. I think it's something like leaves on the trees. But well, the most simple it is, the better it is. I think that just open Excel files and just put the 3 components, and then you, as I mentioned, is common sense. It's well, I have to buy a car, then I forecast that I have to put some petrol in the car, some gas in the car. Then I know that maybe each week I have to put 100 euros in the tank of the car. So you can easily do this. The main thing is to really to be really accurate, is to keep it up to date.
Should one try and get help of an accountant early on, or is that for later?
Yeah, well, the role of the accountant is very important. Each company has a chartered accountant, and it is normal. But you know, when you have to talk with revenue, this is not the accountant that talk with the revenue. It is just you, and then the accountant is just there to help you to manage all the flows in a good way in terms of writing. But it's up to you for each day to look at the statement balance of your accounts and to compare it to the cash flow that you have. Maybe you can see your accountant each month when you come with all the invoices that you have, but it's kind of it's like your emails. It should be always open on your laptop.
I'm trying to go through the questions because we have many questions. Do you have any recommendations for depreciation and amortization for a manufacturing business?
Well, this is typically a question to ask to your accountants. Well, then, but to be more accurate for your special case, but yes, it is important to be aware of your amortization and depreciation, because in my example, when you talk with equipment, for example, if you know that if you buy this equipment and that it is known that this equipment can be used for maybe 20 years without any problem, then you will amortize it on 5 years, for example, but you know that you can use for 20 years. It's a case, for example, for old press. In some manufacturer, there are old presses that are here for maybe a century, that are still working. So this is a good source of profit, in fact, because they do not cost any more, minus maintaining, but they do not cost any more regarding amortization. The net value for the company is nil.
We estimate our investment need on the basis of the cash flow. Do you support this approach?
Well, yes, on the first way, yes. Now it's a little bit difficult to answer here. We have to look at your special case. But as your investment is a bet on the future, then you have normally you have do some forecasting on what you need, and then you know the cash flow that you will have to have in the next months or maybe in the next years. So yes, it's a good way.
The discounted cash flow method for valuation is appropriate for which kind of startups? I guess the ones who have equivalent competitors in their market.
Well, it's depending if you use it for trying to guess if an investment for your company is good or not. As in my example, then you can use it at the beginning of the company. There's no problem. There is no time before which you cannot use it. If you use it for dealing with investors, well, you can use it also for a beginning company, because when you do some company valuation, you can use all the income that you have, all the results that you have already done, or you can also do a valuation using a comparison to other companies that are like you. Sometimes it's possible, sometimes not. And the third big method is to use discounted cash flow, that you explain to the investors that in 5 years the company will generate this amount of money each year, and they will just discuss maybe with you or not. Sometimes they do just the calculation by themselves about the discounted rate. In my example, this is based on the work, but what you have to take into account that the higher the risk is, the higher the discounted rate will be infinite. So, for example, for a startup, very often the discount rate is more than 60% because there is a high risk of failure.
How do I know if my cash flow statements are correct?
Well, it's very simple. In fact, this is what I said. Then, if you keep the statement up to date, and if you compare to the account balance, then you will know if it is correct or not. If there is a difference between both, then that means that you have missed something, and then you have to look again to your numbers.
We have a question regarding innovation projects. How to control the cash of innovation project, since there is no fixed information or data on the innovation project?
Not sure to really understand well your question, but
research.
But I think that well, this is a kind of thing that my grandmother can do. Is when you earn some money, you have to take into account what you will expense. So you cash some money and you disburse some money. It's always true, even if you have a grocery or if you have a very, very innovative companies. The difference is that, for example, sometimes innovative company takes long time to have a service or to have their prototypes and goods ready for the market. So yes, you have a special case for startups, that is that there is no income and you have to pay, for example, your employees, you have to pay for the lab, you have to pay for the prototype, and so on and so on. And well, the quasi only solution is to have some help from exterior. So it could be VC, so investors. So you give some share of your company, and in exchange you have some cash. Sometime, depending on the countries, so it's why I didn't talk about this in my presentation, you may have some public help, depending on some agencies, like in France, BPI, or in another country, there is the equivalent of them. Then you may have incentive, or you may have a zero interest rate loan that could be used at the beginning of the very innovative project to pay some R&D and to pay maybe some top developer or top researchers.
Okay, thank you. Well, I think we went through all the questions for today. Thank you so much, Frédéric, for this presentation, and for the ones who asked. It will be available for replay from tomorrow on, but we will send the presentation as a PDF in the follow-up email. I would like to ask you all to give us some feedback on the webinar, because we want to keep improving these sessions. So it takes just a few seconds, and you may already register for our next webinar on March 26th, addressing crowdfunding. So I wish you all a nice afternoon, and see you next month. Bye.
Bye-bye.